The most powerful central banker in the world may be about to fight a fire that's already out. His name is Kevin Warsh. He runs the Federal Reserve, and right now, the numbers on his desk are telling him to tighten, to lean toward a rate hike, into an economy that is quietly falling apart underneath him. This is the story of a central bank preparing to hike against a macroeconomic reality that no longer exists. This is tightening into a vacuum. The setup, the reality, and the risk. Here is the setup. Kevin Warsh took the Fed chairmanship on May 22nd, 2026. His very first meeting held rates at 3.5 to 3.75%, while the committee projected a hawkish bias. The stated target crushed a 4.2% inflation spike. But here's the reality. That spike was driven overwhelmingly by an oil shock from the Iran war, and by late June, oil had completely round-tripped back below the pre-war levels while the US labor market started hollowing out beneath the surface. Which leaves the risk. The Fed's June projections were drawn up to fight a May fire. He risked a 1937 or 2018 style policy error, tightening directly into a vacuum. The June dot plot. This is where it gets real. The Fed's June dot plot. Every official's rate forecast flipped hawkish. The median year-end projections rose to 3.8%. In plain English, the committee is penciling in at least one hike. The split. 9 of 18 officials see a hike, 8 see a hold, and just 1 sees a cut. That's not consensus. That's a coin flip. And the tell. This same committee voted 12-0 to hold rates in June, but Warsh gutted the statement to around 130 words, abolished forward guidance, and refused to submit his own dot, his line. Inflation is a choice. Inflation highs. Now, on paper, a Fed has a case. May CPI hit 4.2%, the highest since April 2023. The Fed's preferred gauge, PCE, hit 4.1, both multi-year high. But look closer. Energy drove over 60% of the monthly CPI increase. This isn't broad, organic, demand-driven inflation. This is a print heavily concentrated in one thing, a geopolitical supply shock. And supply shocks reverse. The oil round trip. Which brings us to the single most important chart in this entire thesis. Watch oil. Before the war, WTI closed under $70, then the Iran war hit. Brent broke $107 on May 12th at the peak. That's the spike that became your inflation number. And then it collapsed. On June 26th, the WTI closed at $69.23, the first sub-70 close since before the war began. OPEC Plus added quotes. Saudi Aramco slashed prices to Asia by $11 a barrel. The ceasefire held Hormuz reopened. The primary driver of the May inflation spike has already reversed. The fuel is gone. The labor market is cracking. Meanwhile, the other half of the Fed's mandate is flashing red. Above the surface, the headline looks fine. Unemployment even ticked down to 4.2%. But that's the trap. Below the surface, the jobless rate only fell below 500,000 people gave up and left the workforce. Participation dropped to its lowest since March 2021. The household survey showed 507,000 fewer people employed. Payrolls added just 57,000 jobs against 115,000 expectations, and April and May were revised down by 74,000. That's not a cooling labor market, that's a fracturing one. The data disconnect. So, how does a smart Fed get this wrong? One word, lag. The Fed leans on the May CPI data to justify its hawkishness. But May PCE wasn't even released until June 25th, and by the time the data hit, the June oil collapse has already happened. The result, The data Voice is using to build a Hawkish case is a high-resolution photograph of a fire that has already been extinguished. Here is reading yesterday's map to navigate today. Synthesis: hiking against ghosts. Put it all together and you get the core insight. The war's fate has tied its credibility to defeating an energy shock that has effectively defeated itself. The mechanism is the danger. That Hawkish June dot plot describes a theoretical hike. 1. The real-time data will no longer justify by the time the Fed actually meets in September. Collapsing energy, decelerating labor, and a hawkish Fed path, all converging on the same point. If Warsh moves forward with a hike to prove his independence, he won't be fighting inflation. He will be tightening directly into a demand vacuum. Bull case versus the bear case. Now, let's be fair because the Fed isn't stupid. Their justifications. Core PCE at 3.4% suggests inflation is broadening beyond energy, seeping into shelter and services. After 5 years above the target, they would argue anchoring expectations earlier is cheaper than fighting entrenched stagflation later. And with equities near highs, they have room to lean hawkish. But the policy error risk is brutal. The 60% energy contribution has fully reversed. June and July prints will physically reflect that. 57,000 payrolls and falling participations are late cycle recession signals, not a soft landing. And a hike today hits the economy on a 12 to 18 month lag, slamming into a 2027 that's already decelerating. The historical rhyme. And history is screaming a warning. Twice. 1937, the Fed doubled reserve requirement to preempt inflation in a fragile recovery. The consensus, a devastating double-dip recession. Economists still called it the mistake of 1937. Late 2018, Powell delivered a fourth hike in December despite acknowledging softening data. The S&P crashed more than 9%, the worst December since 1931, forced 3 emergency cuts in 2019. But here is intentionally honest part. 2026 core inflation around 3.4% is higher than 2018 1.9. That gives Warsh more justification than Powell had, which doesn't make the error safer. It raises the stakes. Anatomy of a central bank error. This is what the trap looks like as a cycle. A geopolitical supply shock, the Iran war, spikes oil, headline inflation surges to 4.2%. The lagging Fed turns hawkish, signals a 3.8% median. Abolishes guidance, then the supply shock unwinds. Ceasefire holds. Oil breaks sub 70. The Fed hikes anyway to protect its credibility. And that hike hits an already hollowing labor force. The result at the center of it all. A forced dovish panic pivot and a deep risk asset correction. Market pricing is front-running the Fed. And the market already sees it. After the ugly jobs report, beats on the July hike collapsed to somewhere between 10 to 24%. September sits in a wide, uncertain range, roughly 28 to 53% down from near certainty, just weeks earlier. Then, there is the gold, reaping above $4,100. That's not a pure inflation bet. Falling real yield expectations and safe haven demand mean the market sees the slowdown coming. The market sees the vacuum. The Fed's start do not. What breaks this thesis? Now, because we are being honest, not just loud, here is what would prove this thesis wrong. 1. If core CPI and PCE keep rising even as crude falls, inflation is genuinely entrenched and the Fed is vindicated. 2. If the fragile US-Iran ceasefire collapses and Hormuz gets disrupted again, the energy shock simply reloads. 3. If the August 7th job reports rebounds above 150,000 with no negative revision, the crack king labor market argument falls apart. And 4. If the wage growth breaks well above 3.5%, that signals a wage price spiral running independent of oil. A catalyst calendar. So, here is the roadmap to resolution. Mark these dates. July 14th, June CPI, the first data point to physically reflect the oil collapse. The FOMC meeting, wars pressure at 2:30 p.m. Eastern. July 30, June PCE landing the day after the decision. Then August 7th, the July jobs report and the definitive test for the labor iceberg. August 28th, Warsh Jackson's whole keynote critical now that he is killed forward guidance. And September 15th and 16th, the FOMC meeting with a fresh dot plot, the ultimate resolution point. The final bottom line. So here's the bottom line. The Warsh Fed has abolished forward guidance and stocked its credibility on defeating an energy shock that has already defeated itself. With the WTI back under $70 and household employment plunging by 500,000, the fundamentals data does not support a 2026 hike. The setup is binary, either the Fed backs down and the dot plot gets repriced dovish by Q4, or it hikes in September to fight a ghost. And you get a severe risk asset correction. Either way, now you know what to watch. This was tightening into a vacuum. Hope this video was helpful for you. If you like our video, please like and subscribe our channel. Thank you.